All right. Well, no countdown. I thought we were going to do a countdown into this, but we're live. Ryan,
Hi.
welcome
How's it
back
going?
to
Thanks.
the Casual Friday. You got the memo.
Yep, I'm
Wearing a polo
casual. I'm
shirt.
short sleeves and ready for summer.
I know. It's almost like it's summer. And I, of course, am not casual on our Casual Friday, but that's okay. I'm glad that you were actually on our first Casual Friday attempt, I will call it, not even like broadcast, but attempt. And I think we're working still to perfect the process some, but I think that we're getting there.
So by the time I come back for my fifth appearance, we'll have it all down pat.
You know, it's hard to say. It's hard to be a technical advisor for going live on Facebook plus a financial advisor. But hey, we're making it happen, and we're doing it a little bit differently now. We're going to try this. We're live on Facebook right now, and of course, we will try and upload this to YouTube so we can live on there after the fact. But today we are just doing Facebook. And if you're joining us and you haven't watched this before, Ryan and I are both financial advisors here at Ford Financial Group. And almost every Friday, we have a broadcast that we go live on called Casual Friday. And we cover the week in markets and check out 4 charts that we found interesting from the past week. And so I think as we finish up, I'm kind of just looking how markets finished today. Russell 2000 small caps did quite well. NASDAQ tech stocks had a great day yesterday, and we're slightly higher today. Everything was slightly higher today, other than the Russell. But kind of this week it was tech stocks again, wasn't it, Ryan?
Yeah, and they've kind of been the story on and off throughout the year. I mean, obviously had a good year last year, and then this year it's they've had a bumpy road to get to where they are, but positive overall.
They had a phenomenal year last year. I mean, it was tech is where people went to hide, right?
Yeah,
it was almost an defensive play last year.
Well, it was also it was tech and then everything else last year, right? Like it was so far ahead, and so it wasn't like there was a first place and a second place. It was like first place was in tech, and then everyone else was down, separated.
Right, and when it didn't hurt that everybody was stuck at home on their iPhones, watching Netflix, buying things from Amazon. I mean, it was like tech was perfectly positioned, I guess you could say, for everybody to help everybody weather the COVID storm. But that hasn't been the case this year. I mean, this year really, the S&P's done as well as the Dow, but dividend-paying stocks has really been kind of the answer. Value stocks, I guess, have really been the answer so far this year.
Yeah, and I guess again, focusing on opening up, you get away from the technology stocks a bit, right? And getting back to travel or the banks, energy, all this other stuff that is outside of the technology is being the benefited from it. Yeah,
that and tech valuations exploded over the last year, and so even if they are good investments going forward, in the short term, their revenues need to catch up to these valuations and justify them a little bit. So
right.
Well, good. Well, it definitely seems like markets have been boring, or were at least boring this past week. Down some, but not really. We're not getting a ton, other than the Russell, which can be a little bit more volatile, the small caps. Everything kind of meandered sideways and drifted a little bit higher, but there were no real fireworks this week.
Yeah, it's been slow, and we're kind of entering into those summer months as kids get out of school, people start focusing on other things. And, speaking of the Russell 2000, I think that so much of the volatility that we do see, whether it's up or down 1% or 2%, has to do a lot with those meme stocks that we tend to hear about. They're in that index, and so while all the other indices seem like they're kind of just fluttering around, the Russell can go directionally up or down a little bit more because of those particular stocks.
We will have to do a separate video on meme stocks, but in a couple sentences, do you want to just describe for everybody what a meme stock is?
I mean,
I don't mean to put you on the spot.
Yeah, I think that this day and age, we think of it as the social media stocks that are driven by, whether it be Reddit or Twitter. They are having a lot of momentum behind these particular stocks that really have not done well, and probably have been kind of forgotten. If you think of, whether it's AMC or BlackBerry or GameStop.
And I think probably there's a lot of people betting against them, right? There are a lot of short positions against these stocks.
Yeah, so like large institutions are betting against them, and in a real rational way, it kind of makes sense why these institutions are betting against them, because some of these companies have been circling the drain. But when you get enough of a crowd running against them in the other direction, you can see how momentum and can really affect the valuation of a stock.
So these meme stocks aren't necessarily a meme or a joke. It may have started off that way, but it's almost like they've become this mob revolt against some of these short sellers on particular companies, right? And it's
the media plays it out as your average Joe versus Wall Street, right?
Because David versus Goliath. It makes for David versus Goliath is a great kind of story and narrative to have. Certainly that's not fundamental investing though, right? Where you look at a company and see how it's positioned right now and for the future.
Right.
That's not what's going on here.
Right.
That's probably a topic for another time. And hopefully as we get deeper into summer, markets remain as boring as they are, or as they've been over the last few days. I mean, there's no telling, but
summer could sometimes get volatile for the same reasons I had mentioned, as people go on vacations, pay a little bit less attention to the market. There's less volume, so it makes it easier for the market to swing. And usually, again, we don't usually have these great, summers where the market's going gangbusters. You're usually a little bit more worried about the downside than you are about the upside. During the summer months.
Yeah, even the big trading desks are, people are on vacation wherever they go on vacation. The volume is definitely thinner over the summer.
Yes.
Well, good. Well, I'll tell you what, you picked out a couple charts for this week, and I've picked out a couple of charts for the week that I think that each of us found some things that we thought were interesting and certainly worthy of some more attention. And so let's tee up the first one. The first chart you picked was showing what the second year of a bull market typically looks like. And it's interesting. What struck me as interesting is we're calling this the second year of a bull market, because technically, even though we had COVID last year, was when the bull market began.
Yes. Yeah. COVID, like everything, kind of reset things. And because of the fall in which we had from February to March of 2020, that became technically a bear market, but because of the severity of the drop. And so when the market started to rebound, we entered into what we would call a new bull market.
Right.
And so really what this chart is just trying to show is, to give you some kind of expectations of what a first year return looks like when you start to enter that bull market, and then what the second year looks like. And to be, to give you a frame of reference of the time frame, we are now in our second year of the bull market, because the second year of the bull market started on March 23rd of this year.
Right. A year from the bottom of the bear market, basically.
Yes. Yeah. And there's always this takeaway, when the market is going down, there's this kind of saying that you don't want to miss the first year of the market going up. And you can see why, represented by those dark blue lines. That the average return in the last 70 years of the first year of the bull market is 42%. So you definitely do not want to miss that first year. Now, when the market's going down, you don't have any idea when is this, going to eventually start to pick up. But it's the whole reason though you want to kind of stay invested and wait it out till the market starts to go back up, because you don't want to miss it.
Well, in the interesting, there are a few things I found interesting on this thing that you picked. It's first of all, that the first year performance off the low averages more than 42%. It's no wonder everybody piles in on every dip, because they're viewing it as a buying opportunity. If you have, if you're not prone to panic and you have a long enough time frame, each one of these dips has been an average of a 42% opportunity. Like, give me a break.
Right, and you can see the last one from the COVID bear market last year is hovering closer to 80% was the return for the first year, which was off the charts, because as you can see, it's the highest return we've had in the first year in
and interestingly, I think what you can see here, like if you look in 1982, if you look in 2009, even 1970, those years where it's at or above that 42% average, that second year is lower than the average, right? You look at 02, that second year of the bull market, not great. You look at I say not great. We're talking 10 or 12%. That's still fantastic, but it's just not as big as. Basically, if it seems like if the rebound off the low goes crazy, that second year there's less gas in the tank to keep that bull market propelled forward.
Yeah, it's just, you have to have more moderate expectations in your second year than your first year. I know, typically what happens after a great year, you have 40, 50, 60% return in a year. People think that train is going to keep going at that same pace. And really your expectations need to come back. And that this kind of helps show, again, you're right. Second year, 12.7% average return. That's a great return. Yeah. But you need to rein it in from what it was the previous year, the first year.
Yeah, right. Because it's all in context. When you say when 12% isn't a great return in light of a 40% return, then now your anchor of what is a good and bad return get all messed up. I think the other thing I found interesting is that an average is, let's just round up, average of a 10% drawdown during the second year. So recoveries don't move in a straight line higher, do they? There's some bumps in the road.
Right. And to give a little bit of context of where we are. So again, we're almost 3 months into the second year. And the S&P is up, 8.5%.
Right.
So, we're have done very well for the first 3 months of the second year. And again, looking at this gauge of a 13% return for the second year, kind of gives us an idea as an idea of what can happen.
Yeah. Yeah, I mean, being able to apply some context where you say, okay, well, you're already 3/4 of the way towards that average second year return. It doesn't just give you a reason to moderate your expectations for that second year, but knowing where you are in the grand scheme of things, it's very easy to see, oh, well, we'll probably get that average pullback and then rebound, but not go a whole lot higher from where we might be even today. Now, historical performance doesn't guarantee future results and all of that stuff, right? But if we're at least trending towards the average here, it really suggests that maybe the next handful of months we're really not going to have any huge fireworks on the upside if things hold true. Well, that's it. I like this one. I think you totally picked a winner with this chart. The second chart that you have, let's see if I can make this nice and big for us. Let's see here. I'm going to share the screen and see, maybe I can get a little bit bigger for us.
It's a pretty detailed table.
It's a detailed, this is a table more than a chart. Maybe you could describe this one for us a little bit.
So maybe giving, again, the context to the discussion of why I chose this chart. There we go. I think one of the discussion points right now is what may happen to corporate taxes. And then if you take that further, people may say, well, how does corporate taxes affect the stock market? And so,
well, this is a big topic right now. I mean, this is everybody's sweating taxes, or the potential of more taxes, right?
Right. And so you always want to take a look and say, hey, well, what's happened in the past, when they've raised corporate taxes? And we're going back here, over 80 years of, corporate tax rate changes along with what happened to the stock market in the various, 3 months to a year time frame. Right. And I think a lot of this is always to show that it's not always doom and gloom when this stuff comes about. And I think just to give some, again, a little bit more history of where we've been, Trump had changed the tax rates from, I believe it was 35 to 21. Is that correct, Brian?
Yeah, 21, 22, something like that.
Yeah. And now the discussion's going from 21 to 25, right? So
yeah, I think the idea initially the discussion was 20 to 28, but no one thinks that we're actually. I think that's like a jumping off point for negotiation. Everybody thinks it's going to fall somewhere in the middle of 28 and 21 or 2. Yeah.
Right. So, I'm definitely going to looking at an increase in changes, and then, not to get too deep in the weeds, but then they're talking about the G7, having a more impactful world corporate, tax rate involved with it. And so that adds more to the discussion of what everyone's hearing right now.
Right.
We'll see what happens. But again, having tax rates go up does not mean that the stock market's going to fall off the edge of the cliff.
No. I mean, if you think about it, if let's just think about 35, let's just say to 28. Let's take the worst case scenario.
Yeah.
That's still a 7% lower corporate tax rate than we had just a handful of years ago. And you know what? Companies were doing fine with a 35% tax rate. They'll do fine with a 28 or 25% tax rate.
Right.
There are so many other things that could have a larger impact than a few percent corporate tax rate increase on companies. Whether it's, the news was coming out today talking about how a different approach to monopolies and how that could affect tech companies, whether Google has to spin off YouTube or whether Amazon has to spin off Amazon Web Services. I mean, that has much more impact than Amazon paying a couple more percent or Google paying a couple more percent in their corporate tax rate. And even then, there's so many loopholes that they're all getting through with this inversion stuff. I think with taxes, there's a lot of people say tax hikes and everybody just wigs out because they think, Uncle Sam's taken from them or whatever it is. And we all want to pay taxes and have our money spent responsibly, but I just on the measure of things that stack up over the next 12 months that could cause waves in markets, I just don't have it. I have a hard time seeing how a slightly higher corporate tax rate is any different.
And I think really, this table here kind of shows that really you've only had one really bad instance of where corporate taxes went up, and that was 1941. I mean, It was that's like eons ago. But if you look at it, you had a bad 3 months, 6 months, and 12-year return. Like those are numbers that you probably wouldn't see. The other two 12-month returns that were negative were very moderate to where I don't think people would be losing sleep at the end of the night. And then the other times that they've raised taxes, the market still went up.
Well, and if you look at this also, the first 4 of these are over the course of 3 years. So there are 2 tax increases in 1940, one in 41 and another one in 42. And very obviously we had other things going on in the early 40s, right?
Yes.
The world was going on. So you could even argue, okay, so over the 12 months, markets were down in that September 1941, markets were down 15%. And then the following year, they rebounded and were up 26%, even though the tax rate went higher. That suggests just reading this, it reads to me like there's lower correlation between what the market's up to and what the corporate tax rates are.
Correct.
You have a bear market and then a bull market. Boom, boom, one year after another. And so corporate tax rates going up 7% in 41 and then going up another 9% in 1942. I don't know if that's playing here. I don't know if that's a causal thing, So again, if there's, I think we don't have a modern sample size. If you look, because the higher corporate tax rate last time that happened was 93, and before that it was 68. Right.
So you've had one. You've had like one. It happened one time in my lifetime. It's been 50. It's been 50. Yeah. It's 50 years.
In the last 50 years, we've had one. So that's a sample size that's not really great. But even then, it went up 1% in 1993, and the market did okay. So if it goes from 22 to 25 and it goes up 3%, I think we're all going to be safe. I think all these companies are going to be all right. That's an interesting one. Taxes and inflation seem to be the largest. I think I don't want to say it's what everybody's talking about, but gosh, it seems like that's what a lot of people are talking about right now.
I think it's front of mind. And while, again, we kind of downplayed where the corporate taxes are going to have some large impact on the market, where you could have an impact is if the market's going down for some other reason, right? Already, and then they add that on top of it. That's what markets don't. That's what markets don't like. They don't like negative news already happening, and then you start piling it on. And then the market starts to get exacerbated. Then,
no, it always seems it comes down to like a momentum thing, right?
Yes.
So I'm going to move over to mine. I'm going to try and make this a little bit bigger and then share the screen and make this happen on the fly. This is what we often get are worries about new highs. Is it a good time to invest because we're at a new high? And what's funny is that this chart was current through yesterday. You'll see, if you can see down on the bottom here, it says through 610. Well, the S&P 500 was up 0.2% or almost 8 points today. And so today was the 28th new high for the S&P. And one of the things that I found interesting here is that new highs come in bunches, right? And so we're on the 27th new high this year, but we had 33 new highs last year and 35 the year before that. And so it's almost as if we are in the middle of this. Let me change the banner here. Another cluster of new highs where we had this dearth of new highs in kind of the early 2000s after the 90s and the run that we were on there. Same thing kind of in the mid 70s where we were there. I think it's reasonable to think, if you look at how these things cluster, that we might continue to have some new highs as we go forward.
Yeah, you had mentioned that. I think from a client perspective, a lot of times, at least this comes up in conversations for me, is when clients get a lump sum of money and they have to decide what to do with it. So sometimes that's an inheritance, sale of a house or a business. All of a sudden, a lump sum of money comes to a client and they got to decide, do I put it into the market, maybe even at the allocation of my current portfolio, but again, it's a large lump sum. And they're looking for some guidance in terms of what to do. And I think it's always hard when the market's been up for years and years and years on end, and people are feeling like, am I buying at a high?
Right. Yeah. And the answer is, if you bought today, let's just say, for example, you bought the index today, you'd be buying at the high. Doesn't mean it won't make a new high tomorrow or a few more times this year at some point. And usually, if you're talking about momentum, obviously the momentum kind of comes in clumps here. It's almost like it makes new highs more years than it doesn't if you exclude the Depression and World War II. Because even in years where it's pretty weak, where it's been 2 or 3 or 4, those are still new highs.
Right.
That's still a new peak that it climbs from there. And then the next year, you can see here in the mid 90s, one year there were 5 new highs in the S&P, and then the following year was 77, right? And so, yes, if you had been investing in that year where there were only 5 new highs, you'd say, oh, is it going higher? I'm worried that I'm investing in it when it's at its peak. Well, it's at its peak now, but it may not be at its peak forever. Yeah,
the takeaway I have from here is that, if you, especially this last clump from, let's call it the last decade or so. Yeah. I mean, you could have missed the first 50 new highs and you still would have participated in the next 50 or 100 new highs. It shows how much you could have still missed out on, and you wouldn't want to have sat out waiting for, a reset to happen, because it could have literally take forever.
Yeah. Just in the last 2 years, 2 calendar years. So 20 and 21, there have been 61 new highs. This adds up to 60, but counting today, 61 new highs. It's pretty hard to believe given what we've gone through. And not every year is going to be great, but it still is marching higher. And the fact that it comes in clusters suggests that just because we're at a new high isn't a sufficient reason to be scared of investing when we're at new highs. I'm going to try and go big here with this last one and go full screen. The next one that I've got for us is the S&P return after all-time new highs. And I'm going to make this a little bit bigger here and share it. Boom. Let's see here. Is that too big? No, that works. So this is the S&P 500 index performance after reaching all-time new highs versus its average returns over 1, 3, 6, and 12 months. So on the left side are the S&P 500 average returns since 1957, when the modern design of the S&P 500 was launched. And then on the right side is how the S&P has performed after all-time new highs. So I will admit that generally the average returns for the S&P 500 generally have been better than versus after all-time new highs. And this may be where some of when clients are reticent about investing after new highs, that the performance isn't as good as the average, but it's so close. In 1 month, there's a 0.5% difference between the average performance after all-time new highs and the average returns after 1 month. But you start getting further out, and it's still 0.5% difference in the first 3 months, but the distance is much narrower. And then it's the difference in over 6 months between the average S&P 500 return and then the return of the S&P after all-time new highs is 0.3%, 4.3 versus 4. And then it's, again, about 0.5% over 12 months, but over 12 months, that's a whole lot less. So, it's almost as if after all-time new highs, the returns of the S&P 500 are very, very close to their overall average, which again,
it's
not being afraid.
Yeah, and it shows you're not going to go timing the market for this because there's no purpose in doing so.
Right.
You're basically getting the mirror returns of the average anyways. The market it goes to show the market continues to go up after it's already going up.
Gone up, yeah.
Right.
Yeah.
And you're not losing out.
Right. It's about time. Yeah. It's about being invested, not catching it when it's high, catching it when it's low. And this is maybe even where, you were mentioning clients getting lump sums or big chunks. This is where you almost dollar cost averaging obviously is a good strategy, particularly for somebody who is making money and contributing from cash flow. But this also suggests there's a case to be made where if you do have a lump sum, whether it's an inheritance or you're selling property, to not dollar cost average and just go ahead and reinvest that, because you're not going to catch lows. If we're reaching new highs, if you're looking at the averages, you may not have much to worry about.
Yeah, I believe actually the statistics say that you're better off lump sum, putting your money in as a lump sum. We just know that there's this emotional side that sometimes feels more comfortable with the dollar cost averaging of a lump sum and not pouring it all into one day of the year, hoping that you got it right. That emotionally sometimes doesn't feel right, but statistically, at least the studies say that lump sums work. Yeah,
all things being equal, lump sum investing works. There also, though, when things go on like an inheritance or like a big windfall, there's also some questions about cash flow, and if people are buying things or doing other things then investing, they don't want to put it in and take it out. So there are plenty of reasons to pump the brakes. It's a qualitative and quantitative analysis when you're making those kinds of decisions. But if you are deciding to go straight in and the market's at all-time highs, you can see on average the returns are decidedly average. They're not much better. They're not any better, and they're not even really much worse. So the new highs, boy, we can find anything to be afraid of as investors. And things going so well is something, believe it or not, that people are afraid of. And I get it, but the numbers don't show that it's something that you need to be afraid of, right? Yeah. Well, we've been at it for a half hour. What do you think? I think we can probably wrap it up there. It's always fun to kind of go through these charts. I love seeing what everybody brings to the table every week or every other week or however often we're able to do this, that it's always interesting to find a different perspective and see what catches everyone's attention. And I think in this case, it's really this week, it seems, by the charts you chose and the charts I chose, it's about actually looking at the stats, looking at the numbers, and realizing the things to be fearful of, whether it's corporate taxes or all-time highs, is something we probably don't need to fear as much, or
right,
at all, maybe even in some cases.
And I think that's always important in dispelling because, as you had just mentioned, I think we always try to find the fears of, why the market's going to go down. But if we kind of peel it back and take a look at things, you don't need to be so afraid if anything's going to rhyme like history has.
Yeah.
The market's going to be okay.
Well, and like your first chart, manage your expectations, but don't be fearful.
Yeah.
Let it be boring. I've had to say, with all of this meme stock, GameStop nonsense, it's like investing should be like watching paint dry. It should be boring. You just look at it and it compounds over the years if it does well. And some years are better than others, but there's nothing sexy about it. There's nothing exciting. If you want to do the riverboat gambling thing on these apps with meme stocks, then suit yourself, but certainly don't rest your retirement hopes on, hitting the lottery on some sort of trading silliness, day trading silliness. Well, good. Well, let's leave it there. Thanks, Ryan.
Good to be on.
All right.
Thank you.
Have a good weekend.
You too.
Take care.